Welcome to Let's Talk Money, Honey, the podcast where we break down the barriers to financial success.
I'm Elise Levy here with Holly Henry, and we're your hosts, two financial advisors on a mission to demystify investing, unravel the complexities of money, and sprinkle a little wisdom into your life.
Whether you're a seasoned investor or just dipping your toes into the world of finance, join us once a month as we discuss how to navigate life's financial twists and turns. Just remember, building wealth and living your best life should be empowering, not intimidating.
So listen up and let's talk money, honey. All right, welcome to another episode of Let's Talk Money, Honey. So today we are talking about non-retirement accounts. And I think this is such a good topic because when I say that, I see clients' eyes go like, what? And just really, I think there's a lack of understanding on this topic. So explaining it's going to be great. Holly, take it away.
Okay. Yes, because we do talk so much about let's plan for retirement. And so we talk 401ks, 403bs, and of course the Roth IRAs, but we never really mention about the non-retirement accounts. And that's really what it is. This is money that you're not wanting to put back for retirement. It's money that you might want to access for a goal, whether that be a house later on. And I'm going to be honest, I invested some money last year for a car that I'm wanting to buy this year. It is, and it doesn't have to be for a goal. So basically, it is the money that's kind of outside of your emergency fund because we are not going to put money that's in our emergency fund into an investment account. That is a big no. And we take that money and we just invest it on your behalf, and you can get the money out at any point.
So, speaking of, because you bring up retirement accounts, I think that's good to kind of clarify. So, all retirement accounts, 401k, IRA, simple IRA, they have this 59.5 rule. And you'll hear that number a lot. Now, as everyone lives longer, that number might change, but for right now it's 59.5. And what that really signifies is before 59.5, if you take money out of your retirement account, there will be a penalty on it. There are a few exceptions along the way. You know, there is like a $10,000 exception if you're purchasing your first house, etc. There's a couple other hardship ones, but for the most part, you'll have that 10%. So where the non-retirement comes in handy is like if you need access to funds anywhere before 59.5, which most people will need. And I think too, when we're thinking about retirement, we do have a lot of people who want to retire early. They don't want to work until they're 65. They want to retire at 55. And if you can't pull from that account, where are you going to pull money from? So that's another way that this non-retirement account kind of comes into play. So that's a word. What goes inside this account, Holly?
So, it really depends on what the client wants, what their risk tolerance is, and what their time horizon is. It's very similar to an IRA. We can get whatever you want. And so we can do anything from CDs to stocks to mutual funds to ETFs. One thing that I do say is normally once you hit over $10,000, if this is something that you're wanting to invest, we can get a nice little customized, professionally managed portfolio for you. So it's not like you're bringing me money and you have to decide what to do with it. We can have someone invest this on your behalf. And again, like we talk to you about what is your risk tolerance in this. We don't want to go, if this is money that, yes, it's not your emergency fund, but you want to be more conservative with it. Okay, well, we're gonna invest it the way that you want it to be invested.
Absolutely. And why I'm glad you went over that is because we've seen it. Just because it's in the account does not mean it's invested. So understanding that difference. So going a little more into the weeds, I think if we're talking about investing in a non-retirement account, we should also talk about taxes. So the money that's going into a non-retirement account is after-tax money. So when you pull it out, you will not pay income tax on it. But you have to pay this new kind of tax that we haven't talked about a lot, capital gains tax. So that is any gains you make on what you've invested in. And there are short-term gains and long-term gains. And so let's say Holly bought Apple for $100 a share. So her original purchase was $5,000. Since then, it's grown in value and now it's worth $15,000. And she's owned it for longer than a year. She has a long-term capital gain when she decides to sell. So it's unrealized until that moment she decides to sell. And then she will pay a capital gains tax on the $10,000 of gains. Not the total amount she's selling, just the gains portion. So depending on your income level, that can be 15%, 20%. Holly, anything else tax-wise? I think that's like a big kind of question and maybe a misunderstanding point for a lot of people. So how can
No,
we
and
make it simple?
so we want to hold most of those products. We're not going to be very aggressive the majority of the time. Normally in non-retirement accounts, you're going to want to hold so you can get that long-term gain. That is going to be, in most cases, a lot cheaper than a short-term gains. And we will advise you with this, but something else on why it's key to be working with a financial advisor with non-retirement accounts, because I know it is so tempting to go and get those apps like the Robinhood and do this yourself. But towards the end of the year, if taxes may end up being an issue, because you're going to have this conversation with your financial advisor, we're going to look at your account to see if tax harvesting is something that we can do. And I will say on these nice little professionally managed accounts, we can make them very tax efficient. In fact, there are like tax efficiency portfolios that are out there to where, yes, you may still be making money, but taxes are in mind. And this is key for the high earners that are out there.
Totally. And I think in a perfect world, we're always dealing with capital gains. But the truth is like you can have investments that have lost value. So utilizing those losses against the gains is something that financial advisors can really help you with, and your accountant can help you with as well. And then the other thing I wanted to talk about was, let's say you have all this money, but you really live simply and you don't want to touch it, and you're actually setting this aside for the future generation. Well, what's really cool about that is when you pass away and these assets become your children's or whoever your beneficiary is, they're going to experience a step up cost basis. And I think not a lot of people realize that, and it's such a powerful tool. So when someone inherits these assets, they're going to get, from the day of your death, a stepped up cost basis. So if you've owned Apple for 30 years, you have an incredible gain on that. But if it passes to your child, they get to start over, which I think is such a powerful kind of estate planning tool to use and think about when you're thinking about your assets and what to pass down, what to keep. Holly, anything you want to add on that?
Yeah, I think one of the questions that we get on a regular basis is, when do you start actually putting money into a non-retirement account? Any more than 6 months, you might want to start investing that money somehow. Talk to your financial advisor, but what we see a lot of time is people may have tens, hundreds of thousands of dollars that they have there kind of as a nest egg, and they have it in a savings account that is just not drawing any money. And it's like, at some point, in order to keep up with inflation, you have to invest it. I mean, let's be real. Inflation is so real right now. It's not fun. And at least put it in a high yield savings account, but really just talk to a financial advisor about safe ways or how you feel like is the best to invest the money.
Yeah, 100%. I think we'll always go back to that. And so to wrap it all up, I think we can talk about just how it can be in someone's name. So a non-retirement account can be in an individual's name. It can be in joint name. So you can be joint tenants with right or survivorship if you're spouses or whoever wants to own it together. So whoever passes away first, it automatically goes to that other person. And then it also can be in the name of a trust. So you've established a trust in your family name. It can be in that name as well. So just little different things that you can keep organized. And as always, I'm going to bring up what Holly loves to talk about: beneficiaries. Always check and make sure they're up to date. And that is something we'll never stop talking about. Holly, any last minute things before we wrap up this episode?
The only thing that I just want to tell people is these accounts are super easy to open. They're not very time consuming. This is something that a phone call, a Zoom call, an office visit, whatever. Um, it's easy. There's no reason to just be putting this off. So I'm going to say no excuses in setting one of these up. So that's it. That's it for me.
All right. So tune in to our other episodes. We have great topics. And if there's ever something specifically you want to learn about, please shoot us a message or an email. We'd love to hear from you and we'll try to cover it. Thanks so much.